Hi, I'm Doug Goldstein with the Profile Financial Academy. Thanks so much for coming back to part 2 of this presentation about how to read a bond ladder. If you didn't see part 1, you should know that part 2 actually follows from part 1, so it pays to stop here, go back and watch part 1, and then join us again. These videos were originally designed for clients who use a system called Netexchange Client that allows them to view their accounts online. This is powered by Pershing, a division of Bank of New York. A lot of advisors use Pershing to custody their clients' assets. So we originally made videos to teach people how to use the online lookup. But then a lot of clients were asking, well, I'd like to understand more, and so we got started with this bond ladder proposal. So if your advisor works with Pershing, or frankly, even if he doesn't, he probably will present bond ladder proposals or bond proposals to you that look very, very much like this. So let's take a look at how to read them, and then I think no matter what type of proposal you look at least you'll know some of the basics. So the last time that we looked at this, we went right from the beginning to the end of the proposal. We skipped over all of the summary pages so that we could get right to the part that talks about the specific bonds. And we looked at the specific bonds and this specific chart at what each of the different chart columns mean. One of the things I mentioned in the first video, which I want to mention again now, is that the prices that you're looking at here are as of the beginning of April 2012. The whole point of this presentation is just to be educational. Certainly it's not to make any recommendations. This is not a recommended portfolio for anyone in particular. Each person has his own specific situation, and you've got to make sure you get good advice from a competent, licensed financial advisor. So we started at the end. What we're going to do today is we're going to go back to the beginning and imagine what would happen if you bought all of these bonds. This portfolio consisted of several different bonds from different industries, and when you get the proposal, probably the thing that's most important to you is altogether what the portfolio would look like. So here we go. You get the proposal, you open it up, and you can look at the summary of what's going on. Let's zoom in here. Here we are looking at the buy summary. The first line is the total par value. Par value means the amount of money that you will get at maturity. So we had a series of bonds. There were 10 bonds. Each one was a $25,000 bond, which means that as they mature, they'll pay you back $25,000. But the next line, the total principal value, is showing you how much you will pay to buy that portfolio today. Why is it more than the amount you get back? It is correct. If you did the math, you will lose about $8,633 in principal value by buying this portfolio because you'll only get back $250,000 having invested $258,000. The reason why is because this portfolio basically consists of premium bonds, bonds which are selling for more than they'll pay back at maturity, and the reason that people buy them is because they are getting a higher annual income payment on the portfolio. The next line talks about principal plus accrued interest. Accrued interest is the amount of money that accrues in interest to a bond during the 6-month period until the next interest payment. What does that mean? Normally, bonds pay interest every 6 months. So let's say that you buy a bond which pays interest in January and July, but you come along in March and you buy the bond. Well, someone's been holding the bond from January until March when you bought it. So when you buy the bond, you pay him the amount of interest that accrued to him for those first few months. And then at the end of the period, you will get a full 6 months worth of interest, even though you didn't hold the bond for the full 6 months. This portfolio then will pay you an annual income, or often called a first-year income, of a little over $13,000, which means the cash flow from the portfolio. This is an important number for people who are retired, often because they're looking to get current income from the portfolio. Then it tells you the YTW and YTM, the yield to worst and the yield to maturity. These are very critical numbers in understanding a bond portfolio. The yield to maturity is a calculation of how much you will make or lose. Let's say in this case you were paying $258,000 and you will only get back $250,000. So the yield to maturity calculates that loss, but also calculates the income that you'll be getting from the portfolio over the life of the portfolio. The yield to worst is referring to the bonds in the portfolio that are callable. Sometimes a bond can actually be called before its maturity date, which means that the issuer of the bond gives you back your principal and interest before the originally agreed upon maturity date. This is known in advance, which is why we can calculate the yield to worst. And if that happens, you might actually get back less. Your ultimate yield will be less than the original calculated yield to maturity. That would be, for example, if you paid $258,000 for a portfolio and you expected that you wouldn't get back the money for an average of 3 years, but it turns out you get it back in 1 year, that's accelerating the loss. You don't make it up by getting a lot of interest along the way, which is why the yield to worst would be lower than the yield to maturity. The next line tells us the average rating. In this case, we're looking at a triple B rating, which is investment grade rating. Next line tells us the average coupon, meaning some of the bonds will pay more, some will pay less, but you'll be making an average coupon of about 5.25%. And the average maturity, which is the average length of time of the bonds, a little over 3 years. Some of them are going to be more, some of them are going to be less, but because we constructed a bond ladder, we can look at the average maturity length. The average next call lets you know how much time in years. This is 0.16 years until the next bond can be called. In our portfolio, I think only one of the bonds was callable, so this is not really such a big deal. And then the average customer price. We said that bonds are priced at a percentage of par, which means that if a bond's par value is 1,000, which is basically all bonds, you would pay 103.453% of 1,000 per bond, meaning you would be paying $1,034.53 for every bond on average in this portfolio. On this page, there's a little bit more important information. Specifically, the average maturity data here is showing you whether this is a short or intermediate or long-term portfolio. In our case, basically all of the bonds are short-term with a maturity of between 0 to 5 years. Also, the portfolio might consist of many different types of bonds. It could have municipals, corporates, notes, CDs, agencies, treasuries. In this case, the portfolio consists solely of corporate bonds. And finally, we have the aggregate call dates. It tells you that 10% of the portfolio is callable in the short term. Here we are on the next page. We get some information about the credit quality and the type of debt that we had. So the credit quality is showing us that on average this portfolio is a triple B rated portfolio. And depending on the size of the portfolio, you might have higher rated bonds or lower rated bonds. And then on the right side, it's showing us the different type of debt. Again, we saw this previously. We're talking about corporate debt in this case. Finally, we'll look at the estimated cash flow summary for the next 12 months. The reason it can only go to a certain amount of time is because after a while the bonds mature and then, frankly, there's nothing more to talk about. So let's zoom in a little bit here. The top of the chart shows you how much in principal you expect to get back over the next 12 months. And as you can see, if we scan across the top, that we actually don't expect to get any over the next 12 months because our first bond doesn't mature until after a year from now. But it does show you the interest income that you'll get. So for people who are living on fixed income, it's very important for them to know how much they'll be getting every month. Hopefully you're not living literally month to month, but if you are, you could do this calculation. And for example, in April, it shows you that you'll get $593. In May, you'll get $2,375, and this goes on. And 6 months later, you'll see that the numbers are the same because all of the bonds that are on a 6-month cycle are going to pay at the same time. So let's look at that number in June, $1,318, and we'll see that you're going to see that number again in December, $1,318.75. Then there's the maturities. We have, or the redemptions. In 2013, you'll have 2 bonds maturing for a total of $50,000. In 2014, in 2015, 2016, 2017. This is what we mean when we talk about a bond ladder. So it tells you also how your interest will be going down each of those years because you will no longer have the bonds invested in something that's producing interest. Finally, that same information is shown graphically at the estimated payment schedule at the bottom. It shows you a chart of each of the different years coming up, the value that you'll have in principal and in interest payments that are coming due. Okay, so that just about wraps it up for the Profile Financial Academy explanation of how to read the bond ladder charts that your advisor gives you. If you have any questions, you should be sure to speak to your advisor. Ask all of the questions that you have before you invest, because there really are risks involved in bond portfolios. Even though a lot of times people feel this is the safe thing that retirees buy, it's not always true, and you need to get some good professional advice before you buy anything. If you have any questions or comments, please send me an email to Doug, D-O-U-G, at profile-financial.com. And if you'd like to learn more about investing in bonds or stocks or mutual funds or any of a number of different types of investments, please check out the Profile Financial Academy, www.profilefinancialacademy.com. Thanks very much.